This is Nightly Business Report with Tyler Matheson and Susie Garrett.
One popular type of investments that's focused on the future, target date funds. They're commonly used as a way to plan for retirement. The funds automatically adjust and become more conservative as investors approach retirement age. They make long-term investing easy. But are they too simplistic? Joining us now to answer that, Manisha Thakor. She is founder and CEO of her own wealth management firm, Money Zen. Manisha, nice to see you here with us.
Good to see you, Susie. Tyler.
Well, let's first start off by just asking who's good for these funds? How do you know if a target date fund is right or wrong for you?
So there are two great things about target date funds, Susie. The first is that when you invest in a target date fund, essentially what you're doing is committing today to a specific asset allocation, and you are also simultaneously committing to a clearly defined plan to how that asset allocation will change and when in the future. That's huge because asset allocation is one of the key drivers of long-term investment success. And this is one of the reasons why target date funds can be great for new investors, individuals in their 401ks, or individuals who find that they sometimes shoot themselves in their own foot with their own behavior.
So what do I need to know, Manisha, about what's in my target date fund, and what do I need to ask about that glide path of changing asset allocation as I draw closer to my target date?
Tyler, there are three things to focus on. The first is what's the composition of the underlying funds that are in that target date fund? Are they active funds trying to chase after alpha, which the evidence shows has a pretty bad track record? Or are they low-cost index funds, which is what I like to see in a target date fund? The second thing is the glide path, as you mentioned. That's how quickly the percentage of equities shifts towards fixed income and gets more conservative. A good rough rule of thumb, Tyler, is 110 minus your age is a rough approximation of where you'd like to see the equity if you are an average investor in your target date fund. And then the third one are fees. And this is huge, Tyler. For every incremental 1% that someone is charged in fees over an investing lifetime, that eats up 20% of their ending portfolio value. So I like to see target date funds with an all-in fee of 50 basis points or less.
And how do you know how much of your savings you put into these types of funds?
I'm so glad you asked that question, Susie. So one of the great things about target date funds is that they help you save yourself from yourself in the sense that they are a one-decision fund. So if you are a person who finds that you're very emotional, that tracking the market makes you nervous, these are a wonderful investment. And one stat to back that up, over the last 30 years, the S&P has generated a return of 11.1%. But the average investor in equity funds, according to Dalbar Research, has only generated a return of 3.7%. So the vast majority of people aren't capturing their fair share of the market's return. If you fall in that camp, target date funds are worth a second look.
Okay, you've given us a lot to think about. Thank you so much. Manisha Thakor from Money Zen.